Hello, everyone, and thanks for attending my talk. Great. I'm Hao Sun, and I work at Ketchum Trading. Ketchum Trading was formed by legendary trader Blair Hao 3.5 years ago. Prior to that, Blair actually founded and successfully run a Hao trading company since 1985, and later on sold to Goldman Sachs in 1999 for $531 million. I certainly hope Blair can repeat his success, and in the process of making me a very rich man. And however, right now, Ketchum Trading is still fairly small. We have very small, actually, which is joking, half our staff could be our executives. So I'd like to grow, and today I'd like to share my thoughts on general market trends in terms of volume or lack of volume. My background, I started in the financial industry as a financial engineer and 7 years ago, and now I run Ketchum. So this is the graph for the 5 largest US equity exchanges, the trading volume on them, since 1990 till 2012. As you can see, there's a pretty steady growth from early 90 to all the way till 2000. Then it flattened out a little bit, then pick up the pace again. It peaked around 2009. At that time, 6.9 billion shares traded a day among those 5 exchanges. At 2012, it's only 4.8 billion shares. Things hasn't got any better in this year so far. This is the aggregated volume. As you can see, the total equity trading volume has dropped 7% in the first 5 months of the year. Now it's the fourth row in a row. 4 years in a row of decline. For the first 5 months through May, equity trading volume is down 7% from the same period in 2012. It's 9% down for the ETF, 7% for the stock. How about the European market? This is courtesy of the Financial Times. As you can see, the equity stock trading volumes in the European market followed a very similar pattern as the equity trading volume in the US. And on the upper right side, you can also see the foreign exchange trading volume has been going down for a number of years as well. Here's the FIA volume report for 2012. The global futures and options volume fell 15.3% in 2012. As you can see from the graph, this is actually the first year you see a large, significant drop in terms of the futures and options volume. What really happened? What is going on in the marketplace? People are scratching their heads. Right now, you see the volumes are shrinking. The profit also are shrinking. According to the estimate from Rosenblatt Securities, as much as 2/3 of all the stock traded in the US from 2008 to 2011 are executed by high-frequency trading firms. Now it's only half. In 2009, HFTs moved 3.2 billion shares a day. In 2012, it's only 1.6 billion shares a day. Not only the speed traders are trading less, they're also making less money on each trade. Before, average profit is about 1/10 of a penny per share. Now it's 1/20 of a penny a share. So according to Rosenblatt, in 2009, the entire HFT industry made around 5 billion trading stocks. Last year, it made closer to 1 billion. That's 80% reduction. On April 15 this year, the Gecko revealed its profit through SEC filing. It really plunged 90%. With 409 employees, it only made $16 million in 2012, compared with $163 million in 2011 and $430 million in 2008. So this really reminds me of an old Bob Dylan song. The times, they are changing. There are multiple factors that are going on right now, be it cyclical or structural. There are macroeconomic risks, the EU sovereign debt crisis, and euro crisis in Greece and Cyprus. China is slowing down, and there are a lot of talks about potential credit bubble in the Chinese market. The US growth has been anemic in the last couple of years. The banks are cutting back on trading ahead of Volcker Rule. Volcker Rule is inside of the Dodd-Frank Act, which really essentially banned prop trading by commercial banks. Financial institutions are more risk-averse. Just last Friday, there's a report from Bloomberg. It says about US regulators are considering doubling a minimum capital requirement for the largest banks. Last year, US regulators proposed implementing the 3% international requirement for what is known as the simple leverage ratio. Now, the Federal Reserve and FDIC, under the pressure from lawmakers, are weighing increasing that figure to 6% for some of the biggest banks. This could have really large implications in trading. We have been in the low interest rate environment for a number of years now. And also, there's a lot of uncertainty about regulatory reform. SEC and CFTC are still in the process of implementing the Dodd-Frank Act. And there's various talks about potential transaction tax inside the US and also in the European market. I think right now, people are talking, oh, this is all because the machines are taking over. I beg to differ. I think in general, the decline in volume is really caused by the devastation brought by the 2008 financial crisis. The small investors were forced to sell both stocks and real estate at steep losses. At the same time, they were forced to reduce spending to conserve cash, so that the deleveraging process is still ongoing. The baby boomers in the country are not young anymore. The average boomer is 56. They were really devastated in the dot-com bust in 2000, and they were devastated again in 2008. Many of them just cannot be afforded to be devastated again, so people are on the sidelines. What about some other big trading entities? Institutional firm, pension fund, mutual fund, hedge fund? They're trading less because they are uncertain about the direction of the market. The prop trading decks are being dismantled. And high-frequency traders, they are dramatically lowering their trading volume because really the low volatility leaves them with far less opportunity to make money. Banks, typically, they are the traditional principal generator of the volumes, have been slashing jobs in trading during the last couple of years. At the same time, there is also a migration of the OTC product into the listed contracts. There's a futurization of the swap. Like any new product, there's still a lot of uncertainty in how this product will be regulated, how people will trade them. So I think they are having some negative short-term impact on the volume as well. But in the long term, I think it's really good for the industry. Much of the impact of the shorter term, I think at least is to be felt in the liquidity of the market making. As the banks, the traditional market makers, on many new contracts they put out of the market, the prop trading house will be left to pick up some of the slack. So maybe in attempting to make the financial markets safer, the regulators are creating a less secure environment, as really the larger entities are forced to pull out the market. I came across this piece of art a while back, and it really intrigued me. I'm sure the artist, when he created this piece of art, the trading volume or in trading probably not on his mind. But I think there's some thoughts I think I will be able to apply some of his thoughts in general in the trading industry. So here's changing place. I listed the Brazil, BMF, and the Bovespa. That exchange actually rose 9% volume-wise last year, making it only one of the top 10 that had any growth at all in 2012 in the futures and options market. In contrast to its peers at the top of the table, its interest rate, equity index, and single stock contracts actually did pretty well. It has been in a growth mode for last couple of years, and now the access to this market has become much easier. The trend is likely to continue. And on April 1st, that exchange actually lowered fees on its stock transaction by 28%. It used to be 7 basis points, it lowered to 5 basis points. And towards the end of the year, there's talk, depending on the trading volume, it might go down to as low as 2 basis points. Basically, they're really betting on the volume is going to go their way. If the volume keeps at the current level, the exchange is going to incur about $10 million loss through the year. Then there's Japan, the TSE and OSE. As we all know, the 5 largest online brokerage posted record trading volume in May. The equity volume has been going up there. The volatility has also come up there as well. Volatility has been increasing, and investor targeting short-term profit really wants to seize the potential opportunity. The LME, the London Metal Exchange. LME had a very respectable 9% growth in the volume last year, driven mostly by the increased activity in their 3 old futures contract, nickel, zinc, and lead. LME was acquired by Hong Kong Exchanges and Clearing Limited last year in December 2006. And since Hong Kong Exchanges and Clearing Limited acquired LME, it has pushed out a number of initiatives to increase its market access for the Asian players. It also wants to extend its base metal business into other commodities by developing strategic partnership in China. So you want to start out with a coking coal contract and iron ore contract. And it's also looking at some salts and eggs futures contract there as well. Then there's also the China Financial Futures Exchange. Currently, it only offers one contract, the CSI 300 Stock Index Futures. The CSI 300 contract is only 3 years old, but last year its volume doubled to 105 million contracts, making it the most active equity index futures in Asia outside of Japan. I'd certainly like to hear more from the audience. If some of you are already trading in those markets, I'd like to learn more. And certainly I'd like to hear more what your experience are in those markets. There's changing time. Well, a lot of firms like to move from a very short-term, high-frequency trading to a slightly longer-term, mid-frequency or longer-term alphas. And also, as a market maker, you like to combine your short-term alpha in the market making with a long-term alpha in the position taking. Really want to develop a robust model to combine the two types of signals. From the same Gecko 2012 SEC filing, it actually shows Gecko spent $37 million in the first 9 months of 2012 develop trading strategies in its options, global arbitrage, and mid-frequency business. For the king in short-term trading, Gecko actually spent quite a bit of money in developing their mid-term frequency trading strategies. There's changing thought. This graph is the average daily trading volume in spiders. As you can see, it has been going down every year since 2008. At 2013, it's at a level it's not seen in 15 years. On the other hand, you can see a very steady growth in spider options. In 2013, it's actually near all-time high. So as a trader, as more and more investors are expressing their views on stock via options, as opposed to trading actual shares, as a trader, it's definitely interesting to take a look at how spider options traded are positioned, and also how you can position to be participating in that volume as well. There's changing future, literally changing future. There's interest rate complex from CME. The interest rate complex has been in the dormant stage for quite a long time now. Recently, that market is starting to move. It has reached all-time high for the complex on 29th of May this year, with 19.4 million contracts traded, surpassing the previous record of 17.2 million in Feb 2007. And the year-to-date average daily volume is 5.8 million contracts, compared to 4.3 during the second half of 2012. As we expect, there's more tapering talks about the QE from the Federal Reserve. That market is going to be getting more volatile. It will be getting more interesting. I want to close my talk with a thumbs up from a more recent book from Nassim Taleb, The Anti-Fragile. There are three types of systems. There's a fragile system, there's a robust system, then there's an anti-fragile system. I think in the trading industry, really the trading industry is it's constantly evolving and constantly reinventing itself. With so many people, so many smart people in the industry, I think right now we are definitely facing some headwinds from the regulatory standpoint, from the general trading volume standpoint. But I'm pretty sure there will be new crop of trading ideas will be generated. There will be new crop of trading style be generated. The industry will find itself to reinvent itself. And ultimately, I think the industry is really anti-fragile. It can benefit from the disorder. So that's my talk, and I welcome any questions from the audience.
Thank you very much, Hao, for that talk.